$53 billion. Gone in 90 days. China just unloaded American debt faster than any quarter in 5 years, and your retirement account is about to feel it. The sell-off wasn't announced. It wasn't debated. It just happened while Washington pretended everything was fine. Uncertainties, non-uncertainties, uncertainties, nensus, a 15,030 consequence. Every dollar Beijing dumps puts upward pressure on interest rates. Higher rates mean your mortgage costs more, your credit card APR climbs, and your 401k takes hits you won't see coming until the quarterly statement arrives. This isn't some abstract financial maneuver happening in a vacuum. This is a calculated move that touches every American who borrows money or relies on market stability for retirement. Estar 30050 CTA. This channel runs on no corporate funding, no Wall Street pressure telling us what narratives to push or what inconvenient data to ignore. If this kind of analysis matters to you, the kind that connects Treasury auctions to your actual financial reality, hit subscribe and turn on notifications. What's unfolding in the bond market right now will define the next decade of American economic power, and mainstream outlets are barely covering the mechanics of what's actually happening. Storm 53-Mare Deep Dive. Check what happened. Let me show you exactly what happened. Between October and December of last year, China reduced its holdings of U.S. Treasury securities by $53.3 billion. That's the largest quarterly reduction since early 2019. The Treasury Department's own data shows China's position dropped from $816 billion to $762 billion in just 3 months. To put that in context, China held over $1.3 trillion in U.S. debt as recently as 2013. They've been steadily reducing for years, but the pace just accelerated dramatically. The Federal Reserve releases this data with a 2-month lag, which means by the time Americans are reading about a Treasury sell-off, it's already ancient history in market terms. The selling happened quietly during a period when the U.S. government was borrowing at record levels to fund operations. Timing matters here. China didn't reduce holdings during a calm market period. They sold while the U.S. was issuing new debt at the fastest pace in decades, forcing other buyers to absorb what Beijing was dumping. Here's what makes this different from previous reductions. In past cycles, when China sold treasuries, they typically reinvested in other dollar-denominated assets or diversified into euros. This time, multiple indicators suggest the proceeds are moving into gold, strategic commodities, and yuan-denominated instruments. The People's Bank of China has been adding to gold reserves every single month for over a year. They're not just exiting U.S. debt, they're exiting dollar dependency entirely. Metrobortier yikasurs nekimdurst yindurs yindurs yakurs yindurs yindurs yaksurs yaksekt yindurs yadurs yadets yadets yimfies. Why the official story is incomplete. The official narrative from Treasury officials and mainstream financial press describes this as routine portfolio rebalancing. They'll tell you China is simply managing currency reserves in response to domestic economic conditions. Nothing to see here. Move along. The operational reality shows something far more deliberate. Portfolio rebalancing doesn't happen in massive chunks during periods of geopolitical tension. Routine management doesn't accelerate sales precisely when the U.S. is struggling to find buyers for new issuance. What Treasury won't say out loud is that China is making a strategic calculation about the future value of dollar-denominated assets and their own vulnerability to potential U.S. sanctions or asset freezes. Look at the pattern. Russia got cut off from dollar clearing systems after Ukraine. Overnight, hundreds of billions in Russian foreign reserves became inaccessible. China watched that happen. They studied every mechanism the U.S. used to weaponize the financial system. And then they started quietly reducing the one asset that gives Washington leverage over Beijing, Treasury holdings that could theoretically be frozen in a crisis. The Federal Reserve's own research papers have discussed this dynamic, though they phrase it carefully. One recent working paper examined what happens to Treasury demand when major holders perceive sanctions risk. The conclusion was clear but understated. Countries reassess their tolerance for dollar exposure when they see financial systems used as weapons. China is not stupid. They saw the playbook used against Russia and drew the obvious conclusion about their own strategic vulnerability. Maker's 7 Kinds Technical Breakdown. Here's what actually happens when a holder this large sells this quickly. U.S. Treasury securities are considered the safest, most liquid assets in global finance. When demand from the second largest foreign holder drops, yields have to rise to attract replacement buyers. It's basic supply and demand. More bonds for sale, same pool of buyers, price goes down, which means yield goes up. A 1% increase in Treasury yields translates directly into higher borrowing costs across the entire economy. The 10-year Treasury rate serves as the benchmark for everything from mortgages to corporate bonds to student loans. When that rate moves up, every interest rate in America moves with it. The mortgage you're considering refinancing just got more expensive. The corporate bonds in your retirement fund just became riskier relative to their yield. The government's own interest expense on the national debt just climbed. The United States currently carries roughly $34 trillion in federal debt. Every percentage point increase in average borrowing costs adds approximately $340 billion to annual interest payments. That's $340 billion that doesn't go to infrastructure, defense, Medicare, or anything else. It goes to bondholders as interest. And if those bondholders are increasingly foreign entities rather than American institutions, that's wealth transfer leaving the country permanently. China understands this math perfectly. They know the U.S. is trapped in a cycle where rising rates make debt service more expensive, which requires more borrowing, which puts more pressure on rates. It's a feedback loop that has no easy exit. Beijing doesn't need to dump everything at once. They just need to maintain steady selling pressure, while the U.S. government keeps adding $2 trillion in new debt every year. Netchurchsterns, Ertgatcherspier, Netchersier, Matchers, as Netchersier, Yekastier, is Matchers, as Matchers, and then is Macy, Yechwamen, Yadian, Yespayer Seer, Yanine, the math section. The asymmetry in this situation is brutal, and almost nobody in financial media is stating it plainly. China can sell treasuries faster than the U.S. can find replacement buyers without moving yields significantly higher. The U.S. produces new debt at roughly $2 trillion per year. China holds $762 billion. If they liquidated their entire position over 2 years, that's an extra $380 billion per year the market has to absorb on top of new issuance. Who fills that gap? The Federal Reserve tried during the pandemic by buying treasuries directly through quantitative easing. They added trillions to their balance sheet, essentially printing money to buy government debt. That experiment ended with the highest inflation in 40 years. The Fed is now trying to shrink its balance sheet, not expand it. They're not coming to the rescue this time. Foreign buyers, other than China? Japan, the largest foreign holder, is dealing with its own debt crisis and a weakening yen. They're not increasing treasury purchases. European buyers are managing their own sovereign debt issues and elevated energy costs. Middle Eastern sovereign wealth funds have options now. They can buy Chinese infrastructure bonds or fund Belt and Road projects denominated in yuan. That leaves domestic buyers, U.S. banks, pension funds, insurance companies, and retail investors. But here's the problem. These buyers are price sensitive. They demand higher yields to take on more risk. The market clearing price for treasuries when China is selling aggressively is higher than when China was buying. Higher prices mean higher rates. Higher rates mean economic pain. The math doesn't lie. The U.S. needs to borrow $2 trillion per year minimum just to maintain current operations and roll over maturing debt. China's removing $50–60 billion per quarter from the buyer pool. That's $240 billion per year in reduced demand. The gap has to be filled by someone, and that someone will demand better terms. Better terms for lenders means worse terms for the borrower. The borrower is the United States government, and by extension, every American who depends on low interest rates for economic stability. Geopolitical chessboard. China's finance ministry is executing a strategy that Beijing's military and diplomatic corps have been telegraphing for years: reduce dependence on American financial architecture before the inevitable confrontation over Taiwan. Every dollar of U.S. debt China sells is one less dollar of leverage Washington holds. Every ton of gold they buy is one more asset immune to sanctions. Russia's watching this with satisfaction. Moscow already got frozen out of the dollar system. They had no choice but to adapt. Now they're pioneering yuan-ruble trade mechanisms, selling oil to India in rupees and accepting Chinese currency for weapons sales. What was a forced adaptation for Russia is becoming a voluntary choice for the global South. Countries are watching China execute a controlled exit from dollar dependence and taking notes. Saudi Arabia held the dollar up for 50 years through the petrodollar system. Every barrel of oil sold in dollars created demand for dollars, which created demand for dollar-denominated assets like treasuries. That system is cracking. The Saudis are now accepting yuan for oil sales to China. The UAE is clearing yuan transactions through its financial system. Brazil and Argentina are discussing bilateral trade in local currencies. Each of these developments reduces the structural demand for dollars that made Treasury financing effortless for decades. The message transmitting to finance ministries across Asia, Africa, and Latin America is not subtle. Dollar dominance was built on American economic supremacy and geopolitical stability. Both are now contestable. China is demonstrating that a major economy can reduce dollar exposure without collapsing. They're proving alternatives exist, and they're offering those alternatives to anyone who wants to reduce their own exposure to potential U.S. financial coercion. This isn't happening in 20 years. It's happening now. The yuan's share of global payments has tripled in 5 years. Central bank reserve diversification away from dollars hit a 25-year high last year. The BRICS nations are actively developing alternative clearing systems. These aren't hypothetical future developments. These are operational realities that financial markets are slowly pricing in. What they're not telling you. Here's the dimension almost nobody in Western financial press is discussing openly. The U.S. cannot run the global empire it currently operates without cheap financing. The 800 military bases, the carrier strike groups, the nuclear modernization, the endless Middle East entanglements, all of that runs on borrowed money. When borrowing costs rise, choices have to be made. The Congressional Budget Office projects that net interest on the debt will exceed defense spending within 5 years if current trends continue. Read that again slowly. Debt service larger than the entire Pentagon budget. That's not a sustainable position for a global hegemon trying to maintain primacy while facing a peer competitor that doesn't carry the same financing burden. China's debt situation is complicated, but here's what matters. Most of their debt is domestic, denominated in yuan, held by entities the Chinese government controls. The Communist Party can restructure, forgive, or roll over that debt through administrative fiat, if necessary. The U.S. cannot do that with foreign-held treasuries. If foreign buyers demand higher yields, the U.S. has to pay or default. Those are the only options. The Treasury Department will never frame it this way publicly, but internal discussions are increasingly concerned with auction outcomes. Several recent Treasury auctions have shown weak demand at expected yields, forcing the government to accept higher rates than anticipated. This is the market saying we need more compensation for the risk. And the risk is not default in the traditional sense. The risk is inflation, dollar devaluation, or financial repression that erodes the real value of bonds. Every central bank watching this is drawing the same conclusion China drew 5 years ago. Holding massive amounts of another country's debt is a strategic vulnerability, not an asset, when that country demonstrates willingness to weaponize its financial system. The slow diversification happening now could become a rush for the exits if a crisis triggers coordinated selling. And crises tend to arrive exactly when systems are most fragile. 13 or 1430, implications and closing. What's burning through the Treasury market right now is not just bonds. It's the assumption that U.S. debt will always find buyers at low rates, regardless of how much is issued or how recklessly fiscal policy operates. That assumption is a legacy of post-World War II dominance. The world is different now. The math is different. And countries like China are making calculations based on 2024 realities, not 1994 nostalgia. Here are my 3 predictions with timeframes attached. First, within 18 months, we see a Treasury auction fail to clear at expected rates, forcing a significant yield spike that rattles markets and headlines. Second, within 3 years, China's Treasury holdings drop below $500 billion as they complete the strategic diversification they started a decade ago. Third, within 5 years, the U.S. is forced to choose between dramatically cutting spending, significantly raising taxes, or accepting permanently higher inflation as the only way to manage debt service costs. At 13/30/15, which comment hook. Drop your prediction in the comments. Which breaks first, the Treasury auction that forces spiking yields, China crossing below $500 billion in holdings, or Washington finally admitting the debt trajectory is unsustainable? Tell me, because I read every single one, and these predictions shape how I analyze what comes next. Zertems nestertsakim natris yes natrim detin yes matrix 20 share CTA. If this gave you a framework for understanding what the bond market signals actually mean, not just for traders but for regular Americans trying to navigate mortgages, retirement planning, and economic uncertainty, share this with one person who needs to see past the headlines to the structural shifts happening underneath. Yesterday, 2015-35 teaser. The next video breaks down something even more dangerous that Treasury officials are tracking but not discussing publicly. It involves the derivatives market, and the exposure is exponentially larger than the debt itself. Subscribe so you're there when that analysis drops.